Taking note of a host of complaints, the Reserve Bank of India had come out with the first leg of the digital lending norms in August. It allowed loan disbursals only by entities regulated by the banking regulator. The government, too, recently launched a crackdown on several illegal lending apps that were exploiting gullible customers, charging high interest rates, and issuing threats. Some of them are said to have Chinese connections. Earlier this month, Union Finance Minister Nirmala Sitharaman asked RBI to prepare a whitelist of digital lending apps to stamp out the illegal ones. And these concerns were echoed at the Global Fintech Fest on Tuesday, when Prime Minister Narendra Modi said that the fintech sector needed to work relentlessly on safety and reliability. At the same event and on the same day, Finance Minister Sitharaman said that work was on for implementing a common Know Your Customer or KYC that could be used for a variety of transactions across institutions. RBI Governor Shaktikanta Das also added his voice to the conversation, saying that big tech's increasing involvement in the financial system could lead to concentration risk. According to Das, potential risks regarding competition, market and business conduct, data privacy, cybersecurity, and financial stability needed closer scrutiny. His remarks come at a time when big tech companies like Google, Amazon, and WhatsApp are already deeply involved in the country's payment ecosystem. The government's concerns were also explained when Das said that the growth in digital lending during the pandemic had raised concerns, which were evidenced by a spate of complaints about usurious interest rates, unethical recovery practices, and data privacy. A day after these statements, the government's concerns were further elaborated upon by Securities and Exchange Board of India chairperson Madhavi Puri Butch. Once again, at the Global Fintech Fest, Butch said that SEBI was looking to bridge the regulatory gap in the startup ecosystem. She also revealed what fintech firms should keep in mind to avoid a crackdown. First, anonymity in the financial world would be an absolute no-no. Second, transparency would be key. Butch warned that if a business model, including things like the algorithm being used, was not open to being audited or validated, it would not be permitted. And third, the SEBI chief stressed that business models that did not allow ease of exit for customers would not be supported. Under the new RBI digital lending rules, which are coming into effect starting December, lenders must inform borrowers about all fees, charges, and the annual percentage rate in a standardized format. And there can be no automatic increase in credit limit without the borrower's explicit consent. The guidelines also require that the data collected by lending apps must be need-based and taken with the borrower's prior consent. Banks and lending service providers associated with them must also appoint a nodal grievance redressal officer to deal with complaints. Other reporting requirements are also part of the guidelines. The authorities have good reason to be concerned. According to the government, India has the highest fintech adoption rate in the world at 87%, which is significantly higher than the global average rate of 64%. Fintech companies are also expected to have $1 trillion as assets under management by 2030. In 2021, India's real-time transactions crossed 48 billion, which was 6.5 times the combined volume of the US, Canada, UK, France, and Germany. Up to that point, that had been the largest absolute number of real-time transactions in the world. Furthermore, the country's digital payments market is expected to more than triple to $10 trillion by 2026, from $3 trillion at present. As a result, by value, 2 out of 3 transactions in India will be digital by 2026. So, where do things stand at present, and what steps should the stakeholders take to improve the situation?
And I think very, very simply put, for any entity that is regulated by our financial regulators, the RBI, the SEBI, or the IRDA, they have access to their systems, processes, balance sheets to figure out what's happening. If anybody is outside that purview, then the regulators can't really do much about it. And yet, the fact is, a lot of fintechs are actually in that gray area. They're not regulated necessarily by the RBI, but seeming to be in this business of lending or doing shadow lending. And which is why the concern will be, if I don't regulate, if I don't have a view into what they are doing, how soon can it quickly become a social issue? The entire concept of installments or EMIs has become so common. It is also socially acceptable today. But can it become a bigger challenge from the lending space? Probably that's one of the concerns that RBI will have. RBI rightfully is concerned about, and they've spoken about it in the recent past as well, about they don't want India to become highly indebted. My wish list, I mean, can all our regulators, financial regulators, come together and actually put together a India 2030 financial services vision and actually say, hey, this is why we want to work towards.
The government is only trying to say, use the process, use the mechanism, and even the regulator is saying that there is a system to be followed. If you follow the guidelines and if you follow the process, then I don't think there would be a major concern. But what has happened in the recent past, and we have seen that the entire machinery or the mechanism or the vulnerability of the end consumers was misused. We found that there was a lot of arm twisting techniques that were used, and maybe there were certain exceptions that came up, and that exception led to certain extremes in the system, and those extremes which led to some of the consumers, some of the industries complaining about the stress that they had to go through. There were a lot of compliance issues, and maybe some of the fintechs also became vulnerable in the process, and that is the reason why these guidelines had to come out. And I have a feeling that these guidelines over a period of time is only going to help the lending industry to reinvent themselves.
There's no stopping the rise and rise of fintech, but both companies and the government must come together to ensure that the sector presents an overall positive story while minimizing any negative social impacts. Finance Minister Nirmala Sitharaman was recently asked what was needed to ensure trust between the industry, regulators, and the government. Her response was that the industry needed to bridge the distance between it and the government and have more engagements with the latter's agencies. We should keep a lookout for success on this front, which could be a good indicator of where things are headed.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.